Okay, hello everyone. My name is Vikas Agrawal and I'm the founder of AIF and PMS Experts India. So AIF is your alternate investment funds and PMS is your portfolio management services. So at AIF and PMS Experts India, we keep organizing these knowledge-based sessions, and the whole idea is to educate and empower every investor who is looking out to invest money in alternate investment funds and enhancing his overall experience. As some of you might be aware of the fact that we are one of the largest platform in terms of providing the better experience to all our investors, and basically the idea is to share more knowledge about how AIF and PMS works in India. And last time we had a beautiful session, and I would like to take this opportunity to thank all of you for supporting us, liking our videos on YouTube. We've got about more than 5,000 subscribers now. So please do subscribe before we come to you and record the next session. So with me I have Mr. Akhil Chaturvedi. Akhil Chaturvedi is the Chief Business Officer at Motilal Oswal. He brings about more than 2.5 decades of experience in terms of equity investing, in terms of scaling up the asset management businesses in India. Well, I personally know Akhil for more than a decade now, and he's a great human being, very supportive, always ready to help any point of time, both professionally and personally. So I had a chance to work with him, and I truly enjoyed working with him. So I thought, who would be the better person to come here? So Akhil, first of all, thank you so much for taking the time out from your busy schedule, coming all the way from Bombay to Pune, and agreed to do this show for our investors.
Thank you, Vikas. Thank you for having me here. Thank you so much.
Right. So Akhil, before we come to our agenda, which is talking about alternate investment funds, because this piece is shaping up very well in India. I mean, the fact that your AIF, the total AUM, asset under management, stands at 6 lakh crores, and your PMS put together, institutional, has reached to now 4 lakh crores. So this piece is becoming large and large day by day. And of course, Motilal Oswal is pioneer in this segment, and you bring about more than 2 decades of consistent, track record when it comes to managing public money under the PMS platform. So we'll talk about that later, but first let's talk about Akhil. So Akhil, you have been in asset management business all your life.
Yes.
Can you talk to our investors and share your experience?
Yeah, so thank you, Vikas. I look forward to interacting with you in the next 30 minutes. So a little bit about myself. Now I have 23 years of experience in financial services business. I graduated in 1999 and came back to India wondering what to do with my life.
Sure.
And started meeting a lot of people, gave a lot of interviews across sectors, because I had really not carved out particular sector to really start working. So I was exploring, and one of the references reached out to the managing director of Birla Global Finance Limited, which was the NBFC, very large NBFC at that point of time.
Right.
And that's how in January 2000 I got my first break with Birla Global Finance as a management trainee. Mm-hmm. And with 2 years of experience in NBFC, I got an opportunity to move to Birla Sun Life Mutual Fund.
Within the group?
Within the group. So and Birla Sun Life Mutual Fund was really very, very aspirational, because it's something which I could resonate with. I really wanted to work in an industry which is challenging, where it throws challenges every day. So in our business, as you know, we are in capital markets, and markets are throwing surprises every day.
Right.
So every day is a new day, and that is the whole fun, So you need to be on your toes all the time. You need to be more aware about what's happening globally, what's happening locally. And that's the whole opportunity which I thought was really a big breakthrough in my career. So since 2002, I've been in the asset management world, worked with 3 companies now. So for a very long while at Birla Sun Life. Then I joined a Japanese firm called Daiwa Asset Management. And in 2013, I joined Motilal Oswal.
Right.
To grow this business, to scale this business. So that's how it's been now.
23 long years.
23 years. It just looks like it just started,
Right.
And here we are now talking to you.
Correct. So you saw mutual fund industry scaling up big time in front of your eyes. At the same time, when you took over as head of sales at Motilal Oswal and head of business development, you were the early entrant, I would say, to understand the potential of these two instruments, AIF and PMS. Of course, Motilal started their PMS in 2002, but 2013. So what was going on in your mind when you were planning to scale this up to this level?
No, so certainly, when I joined Motilal Oswal, and Motilal Oswal they have been the pioneers of portfolio management services. We started this business in 2002, right? So now we have 20 years of experience, perhaps the oldest PMS solution provider. Right? This business started off with passion of our chairman, Mr. Agrawal, his investment philosophy. And initial days it was more of an invitation basis product, and this vehicle allowed Ramdevji and our investment team to manage boutique portfolios, creative portfolios which were very, very index agnostic, absolute bottom up, focused investing, concentrated style, high conviction portfolio, which would have been little challenging to manage on the mutual fund platform. So that's how portfolio management service, which gives little bit of more flexibility to fund managers, to use their creativity in creating a very, very niche portfolio in endeavor to create long-term wealth creation and long-term alpha. So if you see a bunch of our PMS products are now, the oldest product is 18 years old, the second oldest product is 15 years old, and if you see the oldest product over 18 years has given 2.5% outperformance.
So what's the CAGR there?
So that's about 20% compounding vis-a-vis Nifty 50 of 17.5%.
So if you have to quantify for investor, 1 crore would have become how much?
It's about 30 crores.
30 crores, wow.
Versus index of maybe 18-19 crores.
Wonderful.
Right. The other very, very successful portfolio we had was the multi-cap fund, very popularly known as Next $1 Trillion Opportunity. It is our flagship strategy with $1 billion plus of AUM. This fund has delivered in 14 years 18.5% compounding versus benchmark of 13% compounding. So in long term, clearly this style and focused investing has clearly proven to demonstrate very high outperformances, thereby creating enormous wealth for long-term investors.
Right.
In short term, it could be anybody's guess, but I believe that the PMS and the AIF platform, because of the flexibility part given by the regulators, in long term certainly has a lot of potential to deliver alpha.
Right.
And when I say long term, means clearly we're looking at 5 years plus.
Right. So Akhil, you saw in 2012 this AIF piece is getting regulated by SEBI. Otherwise people used to call it venture capital, private equity, whatnot. And 2015 was the time when you started preparing for AIFs. I am talking about CAT 3. Of course, CAT 1 and 2 is something that you've been doing as an organization for more than 1.5 decades, even before it got regulated. So can you talk to us and tell us more about because this is a question that I get from my investor more often, is which vehicle one should choose? Is it AIF which is better? Because we are witnessing huge amount of alpha coming in the AIFs, or the PMS or mutual fund, because you run all three.
So I would say that all platforms are offering their own advantages. I would believe that mutual funds clearly is one of the most efficient vehicle for any investor to invest across products, across asset classes. Very, very nice, very clean, very tax efficient kind of a structure. But mutual funds, because it's a mass retail product where you have investors who are putting as low as 100 rupee of SIP, when you have that kind of a large retail investor base, obviously regulators are extremely careful as to how the investor funds or the retail investor funds are getting managed in the most prudent way, ensuring that the risk is contained, volatility is limited, and one can get reasonable participation in the Indian stock markets, right? So I would say that mutual funds were and will be one of the best vehicles.
Mutual fund to sahi hai.
Mutual fund sahi hai. There is no doubt about that. Now, as India is growing, as India is progressing, as Indian economy is growing, we all know that in the last 15 years, $1 trillion economy has now become $3.5 trillion economy. Per capita of $800 per capita now is $2,500, and we all know the story which is being talked about today, that by the end of decade India should be a $6 trillion economy. So we will double our economy from 3 trillion today to 6 trillion by the end of the decade, which would mean that the per capita income would actually go up 3 times to $6,000.
Right.
Now, what per capita means is basically the total economy or the total GDP size divided by number of people is how much money is there per citizen in this country.
Right.
Now, as the per capita keeps going up, it leads to beyond a certain spend per capita, which is on your basic needs, your basic food, clothing, essentials. Anything you earn over that, which essentially would be $1,000. So over and above $1,000, incrementally whatever money people are making, that a large part of it would go into consumption, right?
Discretionary spend.
Discretionary, so people will try to upgrade their lifestyles, they'll have better homes, better cars, better two-wheelers, better food, better clothes, they will travel around. So that's the whole classic India story where, poor people going into becoming lower middle becoming middle becoming rich becoming richer, and that's how the whole consumer or the consumer discretionary story is playing out. But the other part, all of us and what we have learned from our elders is to save. Right? So India is one rare economy where the savings rate to GDP is 28%.
Right.
And at some points of time it has also been 35-36%.
True.
So a large part of individual income goes into savings, and which would mean that incrementally people income level will move up, consumption power will move up, and savings power will move up. Right. And in the process, in the last 15 years, Indian citizens have created a lot of wealth, right? Now, as people are getting richer, obviously they start to look, when it comes to savings, they start to look at products which are beyond conventional mutual funds. Their expectation is to have slightly differentiated portfolios, boutique portfolios, something which is tailor-made to their interest or their liking, which is where the opportunity of PMS and AIF comes inside. You gave some numbers, statistics on the assets under management for PMS and AIF. In the last 10 years, PMS AUM has grown 10 times, literally, only the equity part, from 30,000 crores to 3 lakh crores. Right? It's been a 10x growth.
Right.
AIFs from 2012 to 2020, again 10 years, from nothing, only the listed side has grown to 70,000 crores. So certainly we are seeing that high net worth individuals, ultra high net worth family offices are looking at alternate products, PMS, AIF, identify managers who can give them those differentiated portfolios to ensure that one, in their overall portfolio they get a bit of a diversification, and also in hope that these products can give better, consistent, long-term alpha over a period of time. But I think we are just at the tipping point. This opportunity will be very, very large. If you see the 2020 Hurun study, what we see is that there are, as on 2020, so the numbers will be much higher last year.
Right.
There are about 700,000 Indians with a net worth of $1 million and more, 8 crores, right? So clearly when somebody has that kind of net worth, that kind of money, will look at diversification into niche portfolios, niche opportunities, and that's where we are seeing incrementally a lot of tailwinds for PMS and AIF, and that's where you see the growth.
So can I say that mutual fund to sahi, as you rightly said, and it will continue.
PMS bhi sahi
It's
hai,
not about
AIF bhi sahi hai.
Right. It's not about mutual fund versus PMS versus AIF.
See, if you allow me very briefly, I'll explain to you. All three platforms are basically funds, and they are trying to underlying buy into stocks. Right. So when you buy a mutual fund scheme, that scheme is also underlying creating a portfolio of stocks. When you buy a PMS, underlying is a portfolio of stocks. When you buy AIFs, again it is a portfolio of stocks. Right. How the selection and the allocation is being done is what makes each of these vehicles different from each other.
Right. So quickly I want to just talk about the flexibility given to the AIF managers here. You know the fact that up to 25% of your money, the AIF fund manager can decide to participate in private equities, which is not the case with mutual fund, which is not the case with PMS. Now, of late, what we are witnessing is some of the AIF managers are able to utilize the platform even more efficiently by participating in unlisted space as well. And when I look at the outcome, well, I'm not saying that this is best or this is bad, but when I look at the outcome, the difference at times, as we speak in last 3 years, there are AIFs which ended up delivering 39% CAGR, and there are mutual funds which is at 19-20%. Now that's a question which I keep getting. So how? So you also have Vision 2030 funds. So how? So because you already have expertise in the private equity space, and then you have Cat 3 expertise. So how are you blending this up and utilizing it?
Yeah, so I'll keep the returns part. I mean, that is just in hindsight analysis. So let's not get into the returns part. I just want to clear through your platform is that it is not the right assessment that when you invest in PMS and AIF, necessarily it has to do better than mutual funds. There will be times, at least in medium term, where it could be anybody's guess, right? Mutual funds can do better, or PMS can do better, or AIF. So, but yes, in long term, if you study, we do see potential of outperformance by the alternate vehicles over the mutual fund, but this is in absolute long term basis, right? So let's not get into return comparison between both portfolios, but yes, from opportunity perspective, from flexibility perspective, you are right that when you do a category 3 fund, where we do our products, essentially these are long only products, long only listed products, but the regulator allows us to manage up to 49% unlisted in category 3 also, up to 49%. Now it depends from manager to manager how much portion of the overall they would want to do unlisted. In our Vision 2030, we for the first time, and I think probably this is the first fund of its type, where we have done a blend of listed and unlisted. What we said was that we'll do 70 to 100% listed, and 0 to 30% unlisted, right? Because this fund is trying to participate from the India growth story 2030. And it's a 8-year-old fund. So we thought that when you have that kind of a duration and you're trying to play the true long-term India story, why not also participate on the unlisted side, apart from the fact that you're doing a lot of listed investing. So with that thought process, we came up with this product, which is a blended listed unlisted product. Happy to say, with the support of our private equity, which is a very large practice we have, we've already closed 2 deals. So we've already deployed 20% out of the 30% allocated limit. We should do another 10%. So this will be actually the first hybrid listed unlisted fund, giving you opportunity to make returns not only from the listed component but also from the growth offered by the unlisted. And unlisted, the potential to make higher money is there because you are buying these companies much early,
right,
before they actually go in for value unlocking.
Right.
You're trying to get at lower valuation, participating in higher growth. So that's the beauty of, one of the beauty of AIF.
Right. I think it's a very innovative way of looking at things, because see, the thing is that you have minimum threshold of 1 crore in AIF, and SEBI is saying that it can go up any point of time, and there are investors who are upgrading from middle income to a higher income, and they would like to participate, but they don't have 1 crore for enlisted and 1 crore for equity. So
Yes.
I think it makes great amount of opportunity for them to kudos to your product team to think in these lines and come out with innovative ideas like this. Yeah. See, the other thing is, Akhil, Motilal is perceived as equity specialist.
Yes.
Right from day one, the way it has been positioned. Of course, performance keeps going up, changing. It's a function of the markets, and there are different styles. So we have also built up our own proprietary based in-house framework, in which we look at that. Sometimes what happens is people look at diversification, and let's say they allocate 50 lakhs to Motilal, 50 lakhs to somebody else, and somebody else. They don't look at the style, and they'll allocate money basis the brand names. So that's what it happens in PMS industry. Now, if somebody is following, like Motilal is following GARP methodology in terms of investing, and somebody else is also following the same, then it is not a diversification, it is actually a duplication. Now, to take your opinion on how important the style is, number one, when you are managing public money, and number two is, can you also talk about, like, in last 1 year, value started doing well, growth stocks are not doing well, and there are contrarians in the markets who are saying that they will have a different opinion. So because you are equity specialist and you look at all different different style of investments, can you talk to us about that and throw some more lights to enlighten our investors?
Yes. So essentially, there are two styles of investing. There is value style of investing. There is growth style of investing, right? Depending on managers' capability, they choose their style and they follow it. What do you mean by value style is basically buying stocks with a higher margin of safety, low PE multiple. So, and you're trying to play on the future growth, right? The growth will come. It is not there today, and therefore the valuations are lower, so you buy and you wait. So that's called value investing. Growth investing is when you are trying to participate in the current growth, so where you are finding companies which are growing today and likely to grow for several years to come. So that's the basic difference between value and growth. Because in growth style you are buying into today's growth, the valuations are slightly higher than somebody who is trying to buy tomorrow's growth, so the valuations are cheaper. Both styles are equally important. At different points of time, different styles will work, different philosophies will work. And like you rightly said, in an investor's portfolio, both styles combination should be there. That is the asset allocation.
They should complement each other.
They have to complement each other. You cannot be that you are 100% growth or 100% value. It has to be a good mix depending on your risk appetite, right? Now, as you rightly said, we are growth investors, so therefore we are participating in today's growth, and our style, GAP is one way of putting it. We call it QGLP, so high quality, high growth at reasonable price. Quality aspect of the market has been underperforming for some time now. We are on to our philosophy, so if you see the quality orientation of the portfolio is extremely high, right? Growth is there, valuations are low, but valuations are low because quality has underperformed, let's say relatively low quality stocks, right? So that is one source of underperformance which is coming from the growth investors, number one. Number two, more specifically in last 1 year, and we have seen this in 2018-19 as well, where markets are going in a different trend and active investors are going on a different trend. Like I told you that most active managers will invest in quality because rule number one for active investors is to manage risk, ensure that you don't lose money. So quality orientation will be paramount, will be on top of any active fund manager. Markets don't think that way, so when you buy index, you will find high quality, low quality, you will find everything over there. In last 1 year, more specifically, we have seen that 80% of the returns from the benchmark has come from public sector banks. Within public sector banks, the mid-sized public sector banks have done phenomenally well out of the blue, right? Followed by your CPSE index, followed by the metal index. Now, these three components have produced 80% of the return. Right, and these three are very, very cyclical in nature. Quality orientation is absolutely not on the top, which is where if you see any active manager, the allocation to these three sectors either is zero or under allocated, right? Which is where the underperformance is coming from, because what you are not owning is flying and what you are owning is actually flat to getting corrected, and there is where the source of underperformance vis-a-vis the benchmark is coming. Now these scenarios will come from time to time, and at that point of time one has to relax, not purely look at underperformance and outperformance in short medium term. Look at the underlying portfolio, chase the growth, chase companies' earnings, and from there one should get the conviction that in long term, if the fundamentals of the active managed portfolio is better than the passive portfolios, then the outperformance will certainly catch up. But from time to time, you will see that this kind of situation will happen. In 2018-19, if you remember, markets were very polarized towards 15 stocks. Your Reliance Industries, Twin HDFC, and Twin Bajaj. Now, if you are under allocated or not allocated, then there is an underperformance. So, investors, through your platform, I would say that in these situations, when you see underperformance, try and understand the source of underperformance. If the underperformance is not fundamental, then one should not panic and one should have the long-term orientation. And yes, if you feel that fundamentals are not in place then one needs to take a call in terms of rebalancing. So last 1 year has been very, very challenging for most of the active managers, I would say, but that is also creating an opportunity for value investors.
Right.
Not in the typical way, but most active funds, because of the underperformance, are now looking.
So growth is become value now.
Yeah, growth has become value.
Okay.
So this is the best time to buy growth at the right price. Growth at reasonable price. That's the GAP formula.
Great. Well
I think in long term, certainly, what I see in our portfolios, our portfolio earnings growth is far better than the benchmark earnings growth. Our quality orientation measured through return on equity is far better than the index, and our PE multiples are far lower than the benchmark. Now we have put the matrix in place. We have to wait for the markets to give us our due, and that is where you will see phenomenal outperformance. Sorry,
major alpha would start coming.
Yes.
Okay, Akhil, before we talk about the products of Motilal Oswal as an investor, which one I should choose, I just want to ask one more question. You joined Motilal Oswal the beginning of the era when AIF PMS was shaping up. From 1,000 crores AUM, we have seen 30,000-40,000 crores of asset under management. You've been dealing with 25,000 investors at an organization level. What's your experience? Because one point that you highlighted is that there are times when the performance is not as good as it's supposed to be. The commitment from the instrument, the platform. And there are times when mutual fund would do well, or there are times when AIF would do well, there are times when PMS would do well. And that is a crucial time for investor to stay back. Now, so every time when I speak to my investor, I tell them that, you should look at these instruments from 10-15 years point of view. And thankfully, in your early part of career, before you join Motilal Oswal, you've seen mutual fund investors staying in the fund for 10-15 long years.
Yeah.
Do you see same trend emerging in AIF PMS in India? Because people come with some pre-mindset that they want to make out some maximum in 2-3 years time and come out of it. What's your message to them?
So this is a very, very, very interesting question. 23 years of experience. What I have realized is what happens really over a 3-year period is typically, if your allocation into products is happening into products which have done extremely good in terms of returns, very, very good returns, best performing funds, top 3, 4, 5 funds. Usually they are the best performing funds, they are top 2, 3 funds, because the underlying portfolio, underlying stocks have done phenomenally well, which is reflecting into the NAVs. We get our confidence from the past returns, and we tend to over allocate into the best performing funds of the past 1 year, 2 year, 3 year. Like any portfolio or markets also, when there is a period of extreme high performance, there is a period of cool down. So when you invest in these high performing products, best performing products, top quartile products, if you do that at the wrong time, there is a high possibility that you will go through underperformance for the next 3 years, because there is a time correction which happens.
Right.
Now, if at all you have done that by investing into good portfolios, but maybe at slightly higher levels, then you should have a long-term outlook. You will go through a little bit of a downturn, and from there the portfolio will pick up, as long as the underlying portfolio philosophy, style, quality orientation is very, very high. But if you want to avoid this, then my humble suggestion would be to stop looking at past returns and then allocating your money. My suggestion would be to consult people like you, who can show portfolios from future potential perspective and not from what has happened in the past, right? Because you are studying the portfolios carefully, you are talking to the fund managers regularly, you are assessing the growth and the valuations regularly. Therefore, you will have some idea that which portfolios can deliver better in the next 3 to 5 years. Like we say in markets, buy low, sell high. So your job is basically to identify portfolios which are low today and have potential to become high, and that is where money making happens, right? So my suggestion to investors will be that, apart from looking at the past record, fund manager, philosophy, track record, all these things are important to give you some sense about the manager, but nobody knows which fund will do good in the future. Nobody knows, right? So from that point of view, you need to assess. You need to go into the portfolio to see what are the future trends, right? Which sectors have the potential, at what price you are buying the portfolio. Eventually it is about valuations. Buy growth at right price. Simple as that, right? So then this experience of going through patch of underperformance can be avoided. Potentially can be avoided, right? Now, so that's one part in terms of your allocation. The second part is that whenever you're investing, it is important to understand that whichever portfolio you're investing, what is the underlying construct of the portfolio. For example, at Motilal Oswal, for a very long while now, we have been over allocated to banks, to financials, to auto, to insurance sector, and incrementally we are also adding capex, right? Broadly, if you see our portfolios, 80% of the construct is in these 4 or 5 building blocks. Banks, financial, insurance, auto were completely or very headwinded for the last 3 years. And now as things are changing, as profitability is coming back to the banks, as demand is leading to more auto demand, leading to profitability back to the auto sector, insurance after COVID is now, all the bad things are behind, and the growth is coming back. This part of the allocation is now starting to reflect the comeback of returns, right? So we held on to our conviction through the last 3 or 4 years. We had to pay a big price on the performance side, but these are the same sectors now which are starting to add value to the portfolio. We feel that the same sectors, essentially the banking, consumer, and your capex, for the next few years, these are some of the spaces where alpha creation will be there. And we have done our bulk of allocation in these sectors, and within that obviously we've taken the best businesses, right? So now this same allocation, if you see from past perspective, you may find that the returns are not there, but the potential in these sectors from next 5-year perspective is very high. So we have to think from future,
right? What
is going to happen after 3 years, 5 years?
You need to look ahead,
right? So you have to be smart enough to identify trends. You have to be smart enough to understand that which funds can give you those trends participation, and then you diversify across 3 or 4 managers who have different styles but broadly similar kind of allocation strategy. So in future then you will be broadly satisfied with the kind of return generation which can happen.
Right, great. So my last question, Akhil, so now you've seen now you've recently hired Chief Investment Officer at Motilal Oswal, Mr. Agrawal. He brings a legacy in terms of performance. He's worked with large organization previously. So what are the changes that you see is likely to happen? A, B is, if I'm the new investor, I'm looking at Motilal Oswal, which fund should I look at this point of time, both on the PMS side as well as AIF side?
Yeah. So because we are an investment firm, right? Our essential crux of the business is investments, and therefore as we are growing and as our size is growing, we have to ensure that we are adequately investing in our investment team and getting the best resources to manage public money. We have been doing continuously in the last several years. You will be happy to note that the size of ours, which is about $6 billion of assets, we have perhaps the biggest investment team of 30 people with 10 fund managers and analysts, right? So we will continuously invest in our investment team, get the best talent to give the best results to our investors. In the same endeavor, we have possibly got the best talent to lead the investment team, which is Agrawal. He's not the CIO per se, but he is the executive director leading investments. And he comes with a 30 years of track record managing funds, being a chief investment officer. His last stint at ASK was 12 years, and we all know the kind of outcomes at ASK under the leadership of Pratik. We are very happy at Motilal Oswal to have him lead the investments from the front. It's been 3 months that he is here, and what I see what is changing is that the selection strategy through QGLP frameworks is working absolutely fine. But incrementally we are adding a lot of new frameworks on the risk control side, right? So we always said that buy right, sit tight, or buy and hold strategy. We do feel that in public money management that perhaps may not be the absolute right way of managing the funds, because investors are assessing your performance on a quarterly, half-yearly, one-yearly basis. So we need to have a little bit of more agility in our portfolios. We need to have much more stringent risk frameworks to ensure that the companies we buy and they end up making a lot of wealth, we take our profits off at regular intervals, so profit booking at regular intervals, so you control the risk of staying into companies with higher valuations for a lesser period of time. So protect the profits which have come into the fund.
Sure.
The second part is how do you contain losses? So from time to time there would be certain businesses which will go through some headwinds, they may go through some sharp corrections, they may underperform the market. So we have put a framework where on a quarterly basis, rolling quarterly basis, stocks which are underperforming beyond a tolerance level would be eliminated from the portfolio, or at least the weights will come down. We are also trying to diversify the portfolio optimally while keeping the portfolio concentrated to 30 stocks, which we are not diluting, but allocating in a way that you are not overexposed to the top 30, top 40% of the portfolio. So bring the weights down in the top end of the portfolio, increase the weight from the bottom, so that there is adequate diversification in the portfolio, which is nothing but diversifying the risk. So these are some components, apart from many components which have been put in place to ensure not staying on with companies which are excessively priced, not staying into companies which are getting corrected very, very sharply or underperforming very sharply, and having a much more even spread of allocation across the stocks to diversify the risk. So these are the three things we have put in place.
So managing the weights even more efficiently.
Weights, yeah. Typically what was happening and in our portfolios is that the top 10 stocks typically would be 55 to 60%. Right now that brings in too much of concentration in the top 10 stocks, and you can imagine a stock which is 10% corrects by 10% can create a 1% drawdown. So we'll try to reduce this top heavy allocation, and if we are equally convinced about all the businesses in the portfolio, then we should have meaningful weights in the tail end of the portfolio also. So we are putting weights also, so minimum 2.5%, except for IPO stocks, 2.5% on the lower side. We are saying that, let's say if a fund manager is buying a stock which is part of the index, do not go overweight beyond 2.5% as compared to the benchmark weight. If a stock is not part of the benchmark, then your higher side is 5%. So a lot of things mathematically have been put in place to control the risk, to control the volatility, and to bring more smoothness, evenness into the returns going forward. So these are just some of the few things which has already been put in place.
So now the last question, as I said, that so if I have to allocate say 5 crores at Motilal Oswal, how do I construct my portfolio?
Yeah, so that
one, so I would of course look at, I would do my own analysis in terms of analyzing, doing risk appetite, etc. But suppose the money is meant for you now.
Yes. So I would say that across the three platforms, one should look at on the mutual fund side. We have a very great emerging product called Motilal Oswal Large and Mid Cap Fund. Just about 3 years old fund, very consistently in quartile 1, quartile 2, in between that rankings, very, very stable, smooth returns. Manager is trying to participate both between large cap and mid and small, 50%, so you get exposure to both sides of the market. Within that, we are trying to make this portfolio more what we call as a leader full portfolio. So all businesses are leadership companies, either in top 3, top 5, top 10. So leadership portfolio. Some differentiated counter cyclical bets we have taken in this portfolio. For example, we have cements which are over allocation. We feel the cement cycle will come back. So there are pockets of value there in the portfolio, and there are pockets which have already delivered a good amount of value unlocking. So this is one fund I will certainly recommend from underlying portfolio plus valuations, both. It's not an expensive portfolio, it's not very cheap portfolio, so it's actually high quality, high growth at right price.
Sure.
So that's first product. Motilal Oswal Mid Cap Fund is absolutely a top line product. 1 year, 2 year, 3 year, 5 year, 7 year. It's a 8-year product. Investors who have stayed in this fund since inception has made 5 times. So 10 rupee NAV is today 52 rupees. So it's a 5-bagger in 8 years. I think clearly very good returns. So if you are looking at slightly high risk fund than mid cap fund, if you're looking at a moderate risk, then it is a large and mid cap. So that's on the mutual fund side. In PMS, I will continue to give my conviction on my flagship strategy, which is NTDOP, next $1 trillion opportunity. 14 years of track record. It has lived through 3 or 4 cycles, bad cycles, global financial crisis, taper tantrum, COVID, and now the war. 4 cycles this fund has gone through. Despite that, it has given since inception 18% return. Last 5 years, there is underperformance. Underperformance is coming, as I explained to you, is by not owning these PSUs or the metals or these kind of stocks, because that's not the theme of the portfolio. We are having a lot of pockets of good long-term wealth creation opportunities. We have 20% plus exposure to the top banks like Kotak, State Bank of India, ICICI Bank. We have the best IT companies which have now gone down, corrected by 30%, TCS, LTTS, LTIS, Tech Mahindra. We have great consumer discretionary names like Page Industries, which is anyways a multi-bagger in this portfolio. Incrementally, we've added Vedant Fashion, which is the Manyavar brand, into this portfolio. So new names are coming in. At absolute beaten down price, we are also participating in tech companies like Zomato. So we have bought that stock at
this valuation.
At very rock bottom prices. It's actually started to contribute positively to the portfolio. We are playing insurance because we feel insurance is a very good long-term theme. We have 2 companies now, Max Financial, and we have Religer Enterprises, which is essentially the care general insurance product. And then 20% of the portfolio is on the economy facing stocks. So we have L&T, we have Concor, names like these, cement, etc. Right? So 80% of the portfolio is more around insurance, financials, auto and IT, and 20% is more economic recovery stocks. Since the performance has been muted, because as I explained to you, these parts have underperformed broadly, but this is where the value is emerging. Growth is in place. We are seeing quarter-on-quarter numbers are coming out pretty satisfactory. PE multiples are not elevated. Therefore, these are the times you buy portfolios like NTDOP with a 14-year of track record. So that's first scheme. Similar to this, we have a thematic multi-cap fund which is called Business Opportunity Portfolio. It's again a 4-year young fund. Here what we are trying to play is that from a 5-year perspective, from time to time different themes come up as tailwinded themes. We started off this portfolio about 4 years back. If you remember, at that point of time, the focus of government was on agriculture, GST, affordable housing. So we started off with those themes till today, where the themes have been rotated into higher focus on consumer, higher focus on financials, higher focus on technology. So these 3 are 80%, and then 20% is on the economic recovery stock. So it's a thematic multi-cap fund. What you should expect in this fund is, from time to time, the themes will keep changing, underlying sector rotation will happen, and it will give you that kind of a different flavor within the multi-cap bucket.
So does it have higher churning ratio than NTDOP?
It will be slightly higher churn than NTDOP, and incrementally now, as mid caps and small caps are offering tremendous value, the manager is actually buying more and more stocks in mid and small, where the value is looking much more attractive compared to the large cap. So that's on the PMS front. So on AIF side, we spoke about one fund, Vision 2030. We've already raised 400 crores. We will close this fund very soon. So all or any investor wanting to have this kind of a blended listed unlisted fund, reach out
It's a
to
good
Vikas,
opportunity for
reach out to
them.
Vikas
Yeah.
as soon as possible. We are in process of launching a very, very innovative strategy, which is going to be led by Pratik, which is going to be the Founders AIF, essentially trying to buy into Indian entrepreneurs, because Indian entrepreneurs, if you go back, have created enormous wealth.
Right.
So we put the frameworks. I'm sure you can share it with your investors. But look out for the Founders Fund AIF. It's going to be an absolute new fund launch.
Sure.
So Vision 2030, Founders Fund. These are the two pure long only products. Third fund, which is slightly different, I would position, is more of a rule-based open-ended AIF called Hedge Multi-Factor. Quant based. So where we have laid down three factors: quality, value, and momentum. So the rules will decide the long only portfolio, and we will overlay this with hedging to ensure the risk protection in case of any sharp market correction. And I think this can be a very, very differentiator as compared to your regular long only funds managed by active. So these are some of the ideations. You can do your due diligence, and basis investor risk profile, you can choose any of the fund amongst all of these things I've spoken.
Great. So with that, we'd like to conclude the session. Akhil, it was absolute pleasure talking to you. Got a lot of insights from you today. It was very meaningful. I'm sure all our investors are also going to appreciate. In case if you have any feedback, please do write your feedback to us, and we'll keep organizing these knowledge-based sessions again and again for all of you, my dear investors. Thank you so much for giving us your patient hearing. We'll meet you again. Thank you.
Thank you so much.